Thursday of last week, I made about $5,000 trading the NASDAQ. And in this video, I'm going to break down exactly how I did that. Now, before we get into the technical part of this video, which I'm sure you all came here for, there's something I want to break down before that because it's just as important. That is a pre-market game plan, all right? I believe that no trader should even be considering trading for that given day if they haven't written out their pre-market game plan, all right? This is something you see with large funds and institutions. They make their traders do pre-market game plans. They make them journal all their trades for data collection, okay? If the big players are doing it, I don't understand why the majority of retail traders are avoiding it. It's very obvious that it's something that you have to do. It's a part of the business. That's how you grow as an individual, as a trader. So the people who are not doing this on a daily basis are simply not taking the craft serious enough, and then you simply can't expect to get any results. So a pre-market game plan is good for multiple reasons, but the main reason why I do it is because I have way more confidence executing trades in certain areas if it's something that I've monitored for a long period of time. So the pre-market game plan will always take place before market open. This right here is my game plan for Thursday of last week. So unemployment claims got released at 8:30, and we have PMI on the agenda at 9:45. Expecting a decently volatile market, expecting to risk my normal amount today. Overnight session started uptrending towards the end of London session. Meanwhile, Asia session was downtrending. Overnight lows are still open, and we could see a large expansion day towards the unmitigated daily imbalance. I'm talking about a sell-off here. If we are going to sell off today, I expect it to happen somewhere around 10 a.m. Still unsure of the bias, which means I'll go off of intraday information. Basically saying to myself that I'm not super confident in where price to go. I have an idea, but I'm not going to marry that idea. So if I get on the charts at market open and I'm bearish and the market absolutely just rallies, right, and it doesn't show me that it wants to go lower, I'm going to have to just accept what the market gives me and not marry the idea of shorting, right? That's essentially what I'm telling myself here. A large gap up day is on the horizon. Again, 10 a.m. reversal to go over the gap fill is still on my radar, and I may look to capitalize short if this is the case. We should see a sell-off towards the gap fairly fast into the open. If we start to displace away, we are likely not going for the gap fill. Good trading. So this was the pre-market game plan of Thursday. And once I break it down, you will see exactly how I follow my pre-market game plan to the absolute T. If we get around to 10 a.m. and I start to see the market selling off or giving me signs that it's about to sell off, I now have way more confidence executing a short position because I'm going off of thoughts that I had pre-market, which were rational thoughts. What a lot of traders do wrong is that they start to believe their thoughts when they are already inside of a position, and that's not rational thinking, right? When you're inside a trade, it's very hard not to operate on some sort of emotion. So the absolute best thoughts you get is pre-market because that's when you are not involved in the market emotionally, right? It's the most rational thinking that you're going to encounter for that given day is pre-market. So therefore, I like to take trades that I also thought was a good idea prior to market open because I know that I was thinking rational prior to market open. So if I go ahead and close this right here is Thursday. Now, 9:30 is this candle here. That was the New York Stock Exchange open. And this low that we made right here at 8:30 is the unemployment claims low, right? This was the low that we made with unemployment claims. And this is a data low, okay? This is a low made with some sort of news factor, news driver. And these lows typically, or highs, doesn't stay open for very long. It's a very, very good point of liquidity that you can use as an idea or a way to predict where price is going to go next. So knowing this, you should pay attention to large economic data drops that makes highs and lows with a large wick like this. This candle made a high and it made a low. We swept the high, the low is open. That's the whole idea behind these data lows and data highs, right? So coming into the morning here, I'm going to click replay and go back a little bit. Coming into the morning, I was looking to short, right? Because that's what I thought pre-market as well. We had a large gap up. So if I go to regular trading hours, you'll see a large gap here in price because the overnight session trended so much higher than yesterday's close, meaning that there's a large gap here, okay? And these gaps, 80% of the time, are going to get filled. So when we gap up a lot, I'm automatically going to favor shorting. If we gap down, I'm automatically going to favor longing because I know it has about an 80% chance to fill in that gap. on about a 90% chance to fill in half of the gap. So that's basically where I got the idea from originally. Now I said to the entire team that if we close below here, that would be a pretty good short towards this data low, right? So not only that, I had one more objective in mind, and that was the optimal trade entry of this range. And then I saw how well we reacted to the 0.79 zone of the optimal trade entry. Notice how price barely taps it, and then we get an immediate reaction to the downside, right? That's a very bearish sign and something I really enjoy seeing if I am favoring shorts. So I had the delivery from optimal trade entry to the downside. Now, if we close below this 2-minute imbalance, as I just said, I was going to look for shorts, right? So if I play the next candle, you see that this candle, it does indeed close below this 2-minute fair value gap here. And I said, if we retrace back into this inversion fair value gap before we sweep this low here, I'm going to take it short, right? I'm going to ride the market short. And so that's what I did. Right there, we come really close to hitting this low, but we don't, right? The S&P 500 didn't sweep this low either. And so therefore, I was very confident in still taking this short position. Not only that, if I take out my premium and discount Fibonacci extension tool here, and there we go, you'll see that equilibrium of this small 1-minute range here or 2-minute range here overlaps very well with this 2-minute imbalance, right? So at this point in time, I have an optimal trade entry delivery. I have a data low that's open here. I have another low that's open here. Keep in mind, there's no SMT here. The S&P 500 did not sweep this low either, and it didn't sweep this low either. So I have a low open here. I have a data low open here. I have a large gap up here. And not only that, but if we take a look at the prior high, we didn't really see a lot of displacement after sweeping this high, right? Price had trouble going higher after sweeping that high, which is a very, very bearish sign, right? Normally in a bullish market, you would want to see just an immediate rally above the high once we sweep it. So for example, right here, notice how the market comes up, sweeps the high, and then just continues to rally. That's a very bullish sign. So we take it in the opposite direction here, sweeps the high, and then starts to struggle, right? Very bearish sign. So all that combined just gave me a nice opportunity to short the market. So shorted from this 2-minute inversion. I kept my stop a little bit large on this trade because of just the previous consolidation, right? Prior to this displacement leg, the market had been very flat after market open, not a lot of volatility going on. So I wanted to give my trade a little bit of breathing room because of the prior consolidation that we just came from. So this was essentially what the trade looked like. Now I said to the team, because of how fast we displaced after hitting this 2-minute inversion, that this was likely a trade that would be very nice to leave runners on. Now, unfortunately for me, on most of my accounts, I was in with one mini contract, which means there's no way I could leave runners on it because I'm in with one contract, right? So no room for me to leave runners. But as you can see, price tapped our equilibrium of the range, our 2-minute inversion, and then we get this immediate displacement candle right there. And at this point in time, I already went break even on this position just because I'm able to recognize conditions like right here. I'm able to recognize conditions and say to myself, okay, we just came from a large consolidation. I technically don't know if we are still inside of that consolidation. So I'm going to protect my capital. I'm gonna preserve my capital and manage this trade as carefully as possible. So I was already break even at this point with a risk-free trade. Now let me show you what happens. We immediately just flushed the low. And the reason why I was very content on taking it off at this low was because NASDAQ swept this low a lot faster than the S&P 500, meaning that we had an SMT divergence on a data low. Now, an SMT divergence is when you have two correlated assets. One of them sweeps a high or a low, and the other one doesn't. That's what happened in this case, and is usually a sign of reversal, or when a reversal takes place, there's usually an SMT present. So I was not interested in holding beyond that. I was fine with the money I was going to get off of 2R on a single or on a singular contract on the E-mini. So that's what I did. Now, I did tell everybody you can leave runners because, again, my pre-market game plan, I also said I'm expecting a sell-off today, and we had that large regular trading hour gap or inefficiency. And as you can see, if I play it out here, the market just continued to sell off and continued to sell off. So I basically caught the higher day here. And I would have never been so confident in this trade if it wasn't for my pre-market journals. So please understand how important these pre-market journals are. And I want to see every single one of you start doing them. Basically, what you do is 30 minutes before market open, you write out your thoughts, you write out your expectations, and that way you gain way more confidence. At the end of the day, I do this end of day check-in where I said, super clean day, follow my game plan in terms of the 10 a.m. reversal. If we take a look at when I got filled, again, my pre-market game plan here says, let's take a look. I expect it to happen somewhere around 10 a.m. That's the sell-off, right? So let's take a look at when I got filled. I got filled at 10:04. So right around 10 a.m., the sell-off starts to take place. That's just through experience. I know that market reversals tends to happen at around 10 a.m. And so that's exactly what happened, right? And let me pull it up again. Follow my game plan in terms of the 10 a.m. reversal to go for the gap fill. This is exactly what happened, and I executed flawlessly for a nice profit. We saw a tight consolidation right after 9:30 open and the gap up. This usually indicates a sell-off is about to take place to go fill out the gap. And as I said up here, we should see a sell-off towards the gap fairly fast into the open. If we start to displace away, we're likely not going to go for the gap fill. We, in fact, did not displace away. We start to consolidate, right? So that tells me immediately that the market is likely going to fill that gap, or at least 50% of the gap. So if the gap is going to get left, we will likely displace away from the gap with the 9:30 opening bell. If the gap is going to get filled, consolidation with 9:30 and expect the reversal to take place at around 10. So that was my trade here on Thursday. Absolutely beautiful. I learned a lot, and yeah, a very repeatable strategy is used here. The technical part is not as important as knowing regular trading hour gaps. When are they going to get filled? How does the market respond when they are going to get filled? Data low here, right? All these things is what matters here, not as much the technical part of it. So an absolute beautiful trade, and I really hope you guys learned something from this breakdown, and I will see you all soon. Thank you for watching. Bye-bye.